Hello, everyone. Welcome to today's session. We'll jump right into it here to talk about current market conditions. Now, let me on video. Looks like we should be good to go here. Market conditions. We're bullish in a bull market, still the upper end of this range. We're seeing a big spike in momentum the last few days, and we've now pushed back into up into that extreme range again on momentum, and breadth is lagging a little bit, and we'll talk a little bit about the kind of the psychology of each of these, and then also sentiment is also to that upside. We'll start at the bottom right here. Sentiment, essentially, when we're looking at sentiment and talking about sentiment, we're talking about in most cases, it's fear or complacency. Okay, so complacency is not the same as greed. Greed is obviously, where you get FOMO. You're aggressively investing in stocks, and the market as a whole, I should say, is moving higher based on sentiment. That also can become complacency, to where it's just like continue to buy, continue to buy, continue to buy. And at some point, when we start to top out, we get a supply-demand shift, and that is really what we're focusing on right here and right now, is what's happening at these edges. The edges are way up here and way down here. When the market is trending this direction or trending this direction, that is the trending move. And when we get to these edges, we either get a pause of that current trend or we get a full reversal of the trend. And so these are locations that we want to be paying attention to, particularly when it means making adjustments to either our portfolio or our allocation or our approach, or essentially it's just exposure to that asset class or that trend that we're following. So in this case, this is S&P 500. We're at the upper end of that range, 91. If we are looking for more upside, it's going to be slower. It's going to be a little bit muted. And the sentiment side of it is saying that everybody expects that, and that's typically where sentiment, we can also look for reversal or contrarian type indicator, primarily on this one right here, where we're saying if everybody is loaded up to one direction, everybody is complacent and nobody is fearful, then that's a pendulum shifting location where we can shift back. Once selling starts, then that creates more selling, and then fear comes in, and it starts with profit taking, and then maybe there's that everybody's running for the door. That essentially is how markets work, and so stock market is the granddaddy of them all in terms of following the leader. Okay, and that is and that's just the way the game works. And so we have to be prepared for situations that could create additional risk, and that's going to be our main topic today, is talking about risk and how to be able to mitigate some of that risk or reduce the risk. It's impossible in any kind of investing scenario to mitigate the risk entirely, and there are ways to do it, I suppose, and depending on the scenario that you're in, to have a riskless trade where maybe you're using a stock, you're long a stock, and then you are also long a put option, or long an inverted ETF, or something that creates a hedge so that there is no risk at all. If the stock drops, the value of the put option goes up. And so that is called a hedge or a married put option, to be able to do some different things. The other way is to just flat out sell everything, be in cash. Okay, there's no risk of volatility in cash. The long-term risk in cash is that you're not keeping up with inflation, or there's opportunity cost. You could be doing better with something else. But in most cases, when we're talking about portfolio adjustments and we're dealing with market trends, we're following the S&P 500. The vast majority of time, investors are following the S&P 500. What is it doing? It's trending higher. That tends to be the really big picture perspective in the market as a whole. You can see where we've been, and it's been a fantastic run, and we've been at the upper end of this range. This does not mean that this rally, this uptrend, is over. It just means that within this current trend, this direction, this is an extreme location that is not sustainable, which is due for a pullback, a counter trend, maybe something like this. It certainly can mean that we get a retracement. Maybe it moves like this, and then we bounce around, and then it attempts a rally, and then we break back down, and now it attempts some support here, and it breaks back down. We can certainly reverse or start to reverse our trend from this location. And at all-time highs with the market right now, and the interest rate environment where it's at, that's going to be an interesting scenario that plays out. And that's one of the reasons why I put this bond yield curve here, is because, and I mentioned this from time to time, this inverted yield curve is still in place. A healthy bond yield curve looks like this. Short-term interest rates are lower and long-term interest rates are higher. Okay, every time we have a market top, or at least in the last 25 years, this was the subprime market top. You had short-term yields higher, long-term yields lower. .com, same scenario here, short-term yields here and long-term yields about the same. Okay, so what happened at this market top right here? Right here, we actually had a decent looking yield curve. This was COVID right here. During the entire, and interest rates were just really low across the board. We had flat interest rates all the way from the short-term interest rates, which were basically nothing, to long-term rates. And that's what we all loved. We loved our mortgage payments, our mortgage rates at 3% or less, and our car rates at that. Now the game has just shifted to where we had this run up. We had a ton of easy money or of loose money because of those low interest rates, as well as the pandemic, stimulus checks. And then we had this reversal as this, I'm looking up here, as this reversal started to move lower in the stock market, interest rates started to move higher. As we've been moving this rally, this uptrend, this yield curve is getting worse. Okay, so that historically has never been a good thing. Okay, so we're based on equities and market scenarios, we're just, in terms of monetary supply and debt and the way that the Fed is managing things, we're just not out of the woods. This is that one thing that's kind of underlying everything else that has got to correct itself. It can correct itself in an equity upturn. The economy typically slows down, but the stocks typically will retrace as well. So that's kind of a scenario, longer term scenario, that means potential additional risk. We're at the top end of a trend. We've got a yield curve that is still not traditionally set up to be in a healthy environment, which looks like this. Okay, we want yields to look like that, not like this. And you'll hear all kinds of commentary about, oh, it's different this time, it's different this time. Well, I've been through every single one of these, and it's never different. It just rhymes. Okay, it's going to be similar. The outcome is similar. It's just going to be different players. It's going to be different participants. It's going to be different companies. It's going to be different Fed chairs. It's going to be different banks. Those are going to be different, but the scenario is not going to be any different. And that is, we need that yield curve to look like that. So that's one level of additional risk in equities right now that you want to be prepared for and you want to be aware of. What that means, maybe that means if you typically use a 50% equities, 50%, something else, cash or bonds or something that is considerably less volatile, then that might mean bumping that up to 65% cash and 35% equities, or 40, maybe a 60-40 split. It means starting to rebalance and adjusting the risk away from the more risky asset, which are always, in this case, going to be equities. So the location of these, you can use them at a portfolio level to say, I need to adjust my portfolio. I need to start raising more cash into this rally, or I'm going to stay balanced. I'm in it for the long term. I don't need the cash if there is volatility. And just think of risk as potential volatility. It's really not risk. It's just potential volatility, and that volatility could mean a loss of value in your portfolio, which, if you need that money now, is real risk. That's real money being sucked out of your life. And if that is a scenario that you can't afford to have, I don't think any of us can ever afford to have that, but a lot of us that have maybe a little bit more time than others can maybe allow for a year or two of some volatility to have some things recover, coming back up again. But in most cases, it's just a function of how you need the money and when you need the money and how you're trying to preserve it and grow it from here. And then using different asset classes, using stocks, using equity, using bonds, using commodities, using whatever it is that you're using, or a combination of all of those things, is primarily what we want to be able to do. Is what's working, what's moving higher. Is it stocks? Is it bonds? Is it equities? Is it sector ETFs? Whatever that is, we want to be able to have a part of that. Now, in talking about risk, I want to talk about risk well, let's continue with kind of the market commentary. S&P 500, we talked about that. We're at the upper end of that range. It's still a really, really bullish scenario. We're just not seeing any capitulation type selling. That's going to come. Okay, so we don't want to get too complacent or too comfortable because we're going to have added volatility. That added volatility just means now, it means, are we going to retrace, or when are we going to retrace? Maybe we have a back to this level, and how long is that going to take, and what does that look like for any kind of portfolio? So let's talk about that, because I want to talk about risk in a couple of ways. There's this website I like to use. It's called it's a blank page. Guess I haven't used it that much. I just barely had it open, so I thought it was gonna, oh, that's because I had it open in a different browser. Anyway, I'll come back to that. This will work fine for us for what I want to get into, and that is talking about volatility risk. So I want to talk about options just for a short amount of time, because a lot of people they'll trade options as if they're speculating or gambling. Okay, and that those option trades, essentially they act as leverage, and you can use that as leverage, but a lot of people don't understand what they're doing when it comes to options. So let's use an example. Let's say that I have $5,000, and I have $5,000 that I'm willing to trade or invest, and I decide that I want to put all of that into a call option for whatever, Tesla, XYZ stock, whatever it is. Okay, the second I buy an option, I have to understand the risk associated to that option. Now, the risk, again, is, in this case, we're talking about loss of money or loss of capital, loss of the amount of money that I'm putting in. With an option, and we'll talk about probabilities, with an option, I have the probability of, and it's a guaranteed probability of 100% loss, okay? Because options expire, and because they have an expiration date, and that they have to be above or below a certain level. Let's say that that the option has to be above a certain price for me to profit. And this line in the sand, if it closes below that, I'm guaranteed to lose 100% of that option premium because it expired. It has an expiration date, and it's below a certain time frame. So as I'm utilizing that investment vehicle, and I'm just going to refer to as the option as a vehicle to profit, I immediately am putting myself in a position to lose 100% of the premium, because it is an expiration. It's a function, it's an asset, or it's a characteristic of that vehicle. Options expire. It does not mean they always expire worthless, but it means they can. And so there is a guaranteed probability of me losing or having the option go to zero. If it closes below a certain price at a certain date, then that is a certainty at that point. Okay, it's not a certainty when I initially get into it, but the possibility or the probability is a certainty. The probability might be low, it might be high, but there is a chance that I could guaranteed lose everything. Okay, if I put all of my money into an option. That, a lot of people think that's bad, and it can be bad because most traders trade way too much. I think it can be a good thing, because what does that tell me? That tells me my guaranteed amount that I could lose. I can't lose any more money than that. So what I want to be able to do is I want to be able to define my risk with the highest probability of knowing what the worst case scenario is, okay, and then planning for that. If I buy a stock, I don't have a guarantee of an expiration. Stocks don't expire. They go on forever. They go on until either the company goes out of business or they get bought out. Okay, if it continues to be profitable, it's just going to last and last and last and last. That also is in theory, because in reality that doesn't happen. Stocks don't go up forever, or their technology changes, or they just get bought out by someone else whose company is changing. Think Facebook, think Google, think Meta, think Netflix, think, none of those companies even existed 20 years ago, 25 years ago. They're all brand new. You think back maybe to the 1970s of RCA, and I don't even know any of the names of the companies, but companies that were making television sets, and then even before that, companies that were making radios, companies before that were making buggy whips. Okay, those technologies and those companies are changing, but companies don't have an expiration date on their stock price. So that takes away one of the potential risks, or it allows me to know the probability of that going away, that stock price going to zero. Okay, it's possible, but it's just not probable, or as it, and it's not probable in a very short amount of time. Okay, unless there's, I don't know, there's certain events. Maybe it's a biotech company and they don't get their clinical stage still, which means they have drugs that are not officially approved yet. They're going through all the trials and everything, and then maybe they have a hiccup and they say, oh, we're delayed for another year, or we just flat out got denied, or our clinical trials are growing, tumors in all of our clients, or whatever the case may be. And that stock could drop by 50, 60, 80% overnight. So those kind of risks are real. Or if we have a scenario like 9/11, or we have a scenario like a massive tsunami that we had back in, I think it was, was it 05? It was that long ago. We have these global scenarios that are, they call them black swans a lot of times, where it's an outlier event. Something major happens that is it's just impossible to plan for. There's no way I could plan for 9/11, okay, or a scenario, or even COVID. Okay, COVID would kind of be considered a black swan event. It's an outlying event that can't necessarily be planned for, because we have no idea if it happens tomorrow or it happens in 100 years. And so it's not, a lot of asset managers are just like, I don't need to plan for that, because it's a potential risk that's just not there. So those are risks. Those are risks that we can take care of in other ways. I could avoid that risk entirely by not investing in equities, or investing in something that is guaranteed, like in FDIC insured certificate of deposit, or a savings account, or something that, again, those are guaranteed by the full faith and credit of the government, which is like, okay, what's the reliability of that? At this point, it's very high. At some point in the future, maybe that will change as well. But as of now, being able to say, is there a riskless asset? US Treasuries are considered a riskless asset. You're not going to lose your principal. You're not going to make much money on them either, but you're guaranteed not to lose that principal amount. That's kind of what's considered a riskless asset. So it's very tough to be 100% riskless at any given time. The ways to be able to reduce our risk, though, is with two things. Okay, position size and stop losses. So where do I get out, and how much am I putting in? And I'm going to talk about those just briefly. So the two things that I can control when I'm buying a stock, I can control how many shares I buy. Now, we want to have that in a systematic way. I like to use, for this strategy, between 2 and 2.5% of the amount allocated, or the amount set aside. In this case, if we say it's 100,000, that's just the amount that I'm allocating towards this methodology. It may not be all my money, but I'm going to allocate the amount that I'm allocating of my capital designed to trade. I'm going to use that number here. And if I'm setting up the portfolio, but it may not be all my money. I may have a brokerage account with 100,000 in it, but I'm only going to use 10,000 to trade towards this allocation. Then I'm going to use 2 to 2.5% of the 10,000 versus the 100. So, and this 2 to 2.5% can change. If you're brand new and just kind of learning how to trade stocks and what to trade, and using your brokerage account and buying and selling and just the functionality of it, then I would use way less than 2%. I would use 1 share of a stock, okay, or $100 or something very, very low, just to practice, just to learn, but with real money, so that you understand, because there's always going to be opportunities. There's always going to be new stocks, new ideas, new bull markets, new bear markets. That's just the way that this economy works, and the way the stocks and stock market work. There's always going to be something that is going to be interesting. So we don't need to feel like we're missing out and take full-size trades. What we want to be able to do first and foremost is be comfortable with the platform we're using, be comfortable with the strategy we're using, be comfortable with the tools we're using. And the only way to do that is to do it. The only way to do that is to use the method and use the system and use your brokerage account. But you can do that by risking very, very small, by buying 1 share at a time. And again, that if you know how to use your brokerage account, you're comfortable, you know your risk, you know all these parameters, then fine. But if you don't, then start out by saying, okay, how much do I have to trade? If it's $10,000 that I'm starting with, then what that means that the next stock that I buy is going to be $250. I'm not risking $250. I'm allocating $250, which is 2.5% of my full 10,000. Now I'm going to use a stop loss in addition to that. So this is the first part of the equation, and that is position size. The second part is stop loss. Those are the only two things I can control. I obviously can control when I buy and why I buy, but after that, I have no more control. The market's going to do what it's going to do, and the stock's going to do what it's going to do. I don't have any control over that. And that's what we want. All we want to do is we want to manage the risk. We want to manage how big of a position and then where our stop loss is. So in this case, in most cases, our stop losses turn out to be about 15%, roughly. Okay. Between 12 and 20% on average, but about 15%. So 15% of $250 is 10% is 25. So 15% is about $30. So if I'm buying a stock and I have $10,000 to invest, and my first, well, that's supposed to be 10,000, and my first trade is $250 with a stop loss of 15%, okay, or $30, that $30 of my 10,000 is 0.3%, less than 1%. Okay, a third of 1% is my risk, or $30. Okay, that's the kind of that allows me to take less risk. Now the upside is going to be, who knows? We're going to let it run as long as it'll continue to run. Some of those we get some good winners, some of them they're 10, 15, 20%, some are 50, some are 60, some are losses, but we're going to let the winners continue to run as long as they possibly can. But we want to make sure that we cut the losses quickly, and we've got a predetermined amount, predetermined percentages. Your dollar amount is going to be changing based on the allocation you do and the account size. And don't be afraid of that. Be 100% okay with trading really small, because we're going to be trading a lot doing this methodology. We trade a new stock every day, or we pick one out and we make that trade every day. We're not day trading it. We're not buying and selling it that day, but we're buying something new. At least with this strategy, it doesn't have to be that often. You can do it less than that. But if you're trading smaller amounts but more stocks, we're diversifying across ideas and potential uptrends. Think about a month and a half ago, it was the Bitcoin miners. Think about what's happening right now. Okay, these top three are all biotech or biodrug or bio something. Okay, medical stocks. That's what's working right now. Next month, it's going to be something different. Okay, the next month or 2 or 6 weeks is going to be something different. Like right now, some of these stocks may be starting to shift. We may be starting to move over into coal or into oil stocks, or something else is going to be floating to the surface, coming to the top right here. But we want to take advantage of what is working in the marketplace that it's given to us at this point in time, and be able to ride that train while it's working, right? That's the only way we can judge it, is what is working and it's moving. They're starting to move, and obviously we have methodologies to be able to do that. We're doing new buys, or we're looking for, the system of new buys is looking for uptrends, waiting for that signal, jumping into that trade, setting our stop loss, and then doing it again tomorrow, and then watching this stock and letting it go. And maybe it does this for the next. Okay, let's look at the time frame here, approximately from first buy signal to either a stop out or a sell signal. If we go from here to about here, let's say that full time frame, that's November, that's 1 month, that's 2 months. So about 8 weeks. That's about the typical trend of most stocks in this system, is they'll trend and then they retrace, and they either get stopped out or they get a sell signal and we get rid of it. And now this is a whole new decision. This is a whole new trade if we decide to get into that. And then we do it. So most of the time we're looking at these stocks just through this window. We're not looking at, it's done this and it's gone here and it's had this massive uptrend and it's doing this. And so I think there's this and support and this and that. We're focused on right now, what's happening in the market, this is the trend, it's had a nice uptrend, that's what's working, it's got a new buy. So will that work every single time? No, we know it doesn't work every single time, but that's why we manage our risk. And that's why we say, okay, of this stock, I'm going to have, if I have $10,000, this is 100,000, but let's cut that in half. If I have $10,000 on this trade and I'm going to use 10 shares, okay, that's $525 at risk. Okay, if I have $10,000, that's too big, right? So I need to go half that. Half of that is 5 shares. That's $262 if I do 5 shares of this stock. Now, if I place a stop loss, so that's my position size. My position size is $5 or $262 for this transaction, and that's fine. I don't need to go any bigger. I don't want to go any bigger if that is my plan for that amount of capital. That $10,000, you worked for it, and I guarantee you don't want to lose it. You want to keep it and grow it. That's our goal, is we want to preserve our capital and grow our capital. We don't want to gamble our capital. We want to have a systematic way to preserve and grow our capital over time. And that's what, and we want to use equities, we want to use stocks to be able to do it, because they have really high probabilities and really big of going higher. And when they do, they can move 30, 40, 50, 60, 100% in 6-8 weeks. There's not very many other asset classes that can do that. The hard part is, which one do I buy and when do I sell it and how much should I buy and how much should I sell? And so that's what I want to try and provide, is a way to be able to not make it so hard, make it systematic. And then it's a lot easier to be able to manage and control, because number one, now you have a control mechanism over your risk. You know that worst case scenario, okay, is this stock, SkyWest, okay, the airline, drops to zero. Okay, is the probability of that happening very high? No, it's not very high at all. Is the probability of this stock dropping by 50% very high? No. Is that possible? Yes. The probability of a company like SkyWest, especially if it's been going higher, getting cut in half or going to zero, is very, very small. So I can feel comfortable, but I also, in my position size, because that's my worst case scenario. My worst case scenario is this stock goes to zero. And what's going to happen to my 10,000? Well, I'm going to lose $262. So what? Okay, we spent that at Costco yesterday on bread, milk, and cheese. Okay, so those are other ways to start to consider, what kind of risk am I actually taking with my hard-earned money? This is money I want to grow and protect. I don't want to risk it. I realize there is risk, but I want to be able to know what that risk is and what that exact risk is, so that I can sleep at night. More importantly, so that I can follow a system and a process. Let's put our stop loss right here at 40. Let's call it 48. It's a little bit below that, but I want to be below this area. That's a wide stop, because that gives this stock plenty of room to dance around up here. And I say dance around, I just mean be volatile, be up and down and up and down. And this is what you see in your brokerage account. Up, in this case, up $20, down $10, up with that amount. You're not going to see big numbers with a smaller account, but it's going to be bouncing around like that. And I want to allow that, so that eventually, because I know that that's what the market does. The market creates ups and downs. It's trying to discover. It's two groups of people, buyers and sellers, trying to create price discovery. And it's an auction. Think of it as an auction. If you ever watched an auction, and you've got a bunch of people sitting down and they've got their little cards that they're holding up, and you got the guy up front, and it's like, okay, bid right there. Somebody, $1,000 for this cow. Okay, I grew up in a farming community, so it's like cattle get auctioned, and so it's like somebody's raising that bid price. Okay, I'm willing to buy it. Do we have another bid? Higher? Yes, we have a higher bid. Do we have another bid? Going once, going twice. No, nobody else is willing to bid. The stock market is exactly the same scenario, but at a super, super high level, with lots of millions and millions of participants doing that in real time. Instantaneously, people are making that decision, buying and selling. So it is the marketplace determining what price discovery is of the underlying company. And that's why that's why I like to use stocks, is because the bias, the overall bias for a company is up. Okay? It's always up because that's what companies are built to do. They're built to grow. They're built to make money, and they're built to grow that money and grow that capital. And everything that is designed to go into that company is built for it to go higher. Therefore, the value or the perceived value, which is nothing more than what the stock price is, the stock price is the market's perceived value of that company. And it's an auction. So it can happen all over the place. And sometimes it gets way overbid to the upside. And it's like, oh man, there's no way that company is worth this anymore. And then you get sellers and they sell it and the price moves back down. And then they're like, oh, there's no way that the value, if this company was sold off for all its pieces, it's still 10 times higher than the stock price itself. That's value investing. And you have somebody coming in and saying, there is no way this company is worth this. It's worth a whole lot more. I'm buying it right here. So everybody's decisions are different, but they're based on value of or perceived value of the underlying company. And that's why I like them. It's because they'll move higher. If you have a stock or a company that's a piece of crap and going lower and it's obvious and they're losing money, why on earth would I try and buy that stock? Okay. I don't want to try and buy something that is moving down. I want to try and buy something that's already moving higher. That's what it's called, momentum investing. That's the primary focus that we do. Is we want a stock that's working, it's fundamentally growing, and the stock price is showing that the path of least resistance tends to be higher, but not always. So we have to manage that risk. So in this case, that 0.25 is my 50 risk per share. Where is it? Oh, I don't have the stop listed in there. That's why. 40. Let's put it at 40. Let's just put it at 48 for a nice round number. Okay, 0.02. So if this were a $10,000 account, this would be 0.2 or 0.2% at risk. So in this case, $22. So if I wanted to buy SkyWest today and 5 shares and set a stop loss right here, I know that the worst case scenario is the stock goes to zero. It's not the probable scenario, but I also know that if it moves lower and stops me out and this trend is not going to work and it moves lower, I'm going to lose $22. Can I live with that? Yes, no. Okay. That's the question you've got to ask yourself is, I've done everything else I can do. The stock price is moving higher. I've analyzed it the best of my ability. I'm using a methodology that has proven to work over time. And now what? Now I wait. Okay. And now we just watch and see if it goes higher or not. And then we manage it as it's moving higher. That is essentially really it. If you really think about it, this is the hardest part, is right here and right here. I shouldn't say this is the hardest part. The hardest part is now you pull the trigger and you're in the trade. It's waiting. It's waiting for something to happen. And watching the volatility. So understanding how each individual stock affects the overall portfolio and how much risk you're actually taking is critical. It's just so important to understand how much risk that we have on, because in this case, we have, however many holdings we have open right now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21 holdings. And that's about average. Sometimes it goes up to about 30, but for the most part, we kind of hover in that range. And that's entirely manageable with that number of stocks to be able to, especially where we're doing end of day, any decisions we're making are first thing in the morning. It's just not that difficult to be able to manage that. But let's say, if every single stock in this portfolio lost 50%, that's going to hurt. Okay, what are the chances of that happening? It's the probability. It's possible, but it's just not probable. Okay, but that's the risk that we're now taking, is the number of positions that we start to have open as well. Even now we're think of that bundle of sticks tight together. We now have a bundle of stocks that we have as an allocation versus one stock. If you were to think of all of this as just one stock, and if this were Apple, yes, I might be able to make more money overall of one stock in that allocation. But if I have a bunch of stocks and some are working and some are not, I'm ultimately going to chip away and start to gain some, again, grow and preserve my capital is really the mandate of what we want to be able to do. And in my opinion, the best way to do that with the least amount of risk is to utilize this wheel portfolio that we're focusing on for these strategies. And there's lots of variations to that, but this is the this is really the core of it, is adding into it every day based on a strategy. It doesn't have to be the new buy. We've talked about that in the past as well. You can set up a screen. Maybe it's new buys with volume. So I want a new buy stock, SPNT, that's got a bunch of volume, okay, and it's got a breakout. It's going to have some volatility here in the shorter term. That's not surprising. And then, but that's the method, that's the stock. And then I go in and I do that same strategy as far as whatever I'm adding into my buy. So talking about the risk side of it, remember the 2 points I want you to get away with today, or go away with today, are position size, which is the number of shares that I'm buying, or the size of the position I'm taking on relative to all of my money, or relative to my capital amount that I'm investing. And is that a comfortable level? It can be higher. And when we get, we can play with that number. As we get into early cycle new bull markets, maybe we bump that up to 3% or 3.5%. I think in most cases, just sticking with the 2 to 2.5%, doing that for a year, being comfortable with it, understanding how it's working, seeing some of the volatility and the risk that's associated with that methodology and strategy, is a part of the learning curve to be able to get into as well. And then the second part of that is your stop loss, so that if we do get stopped out of a trade, it's just not a big deal. It happens. It's just a part of what we do, and it's a part of the overall methodology. But we just want to make sure that our winners are way bigger than our losers, and ultimately that's all that matters. We can have a 50-50 win rate, and our winners are much bigger than our losers, and we're going to make money. But ideally, we have both. We have more winners than losers, and we have a risk profile that's set up so that we are making more money on our winners and losing less on our losers. And remember that this is growing, okay? So I say you could bump that up to 3%, but think about what's happening now. Now, this is our current account value. So 2.5% of 100,000 is, 2,500. 2.5% of 125,000 is now what, like 2,800. So I'm still using 2.5%, but that 2.5% on a growing portfolio gets bigger. So my risk, my position size increases because my portfolio is increasing. So I am leveling up into larger and larger positions because 2.5% is getting larger and larger as my account grows. That makes sense. So the scenario, the strategy works, the methodology works. It's a slow enough methodology that is relatively easy to manage and maintain. But if it feels like you're getting too many positions and it's becoming kind of sloppy, and you're like, man, I got too many things happening, trade smaller, trade less shares. It could be 0.5% or 1%, or like I said, one share, or $200 or something like that. And then eventually, as you've done it more and more, you're going to get more and more comfortable with that overall strategy. I hope it was helpful, and I'm going to finish up on that note. Everyone have a fantastic day and a fantastic weekend. We'll see you next time. Bye now.